Real estate investment presentation, property tax deduction. Get ready because we're raising the stakes with real estate. When considering the deductibility of property taxes, remember we're talking about income taxes, more specifically federal income taxes here. As we think about taxes, we have to note that those are going to be subject to changes in the law in the future. In other words, when we're thinking about a long-term investment, we want to take into consideration the risk related to changes in the law, which could have an adverse effect to us in the future. Now, the property taxes here is something that's been on the code for some time now, and although it's going to be a controversial area, you would think it unlikely that they remove it entirely. However, you could see changes to the tax code that could have a positive or negative impact with regards to the deductibility of property taxes depending on your circumstances. So you want to keep that in mind as you make those long-term kind of investment type of decisions. Now, as we go forward, we're going to be referencing Investopedia. Investopedia, a place you can go to look up investment-related terminology and continue your research from there. So what is the property tax deduction? State and local property taxes are generally eligible to be deducted from the property owner's federal income taxes. Deductible real estate taxes include any state, local, or foreign taxes that are levied for the general public welfare. So in general, we're talking about these taxes, which are state and local taxes then, that could possibly be then deductible on the federal side of things. So note, you're talking about the federal income taxes. Can we just deduct then some of these state and local type of taxes with regards to our federal income taxes, thereby giving us a benefit on the federal income taxes? One of those big types of taxes then, the state and local taxes, would be the property tax. And that's one of the big two types of things that often push people over from the standard deductions to the itemized deductions. In other words, note that you're only going to get a benefit from this kind of deduction generally if it's from a home that you have from going over the standard and taking the itemized deductions. And the thing that pushes most people over to taking the itemized deduction is usually owning a home. Because if you own the home, then you're going to have to pay two big things that could be deductible on the itemized, one being the interest on the home, and the second being the property taxes on the home. Those two things coupled together often push people over from the standard deduction to itemizing. However, note that the standard deduction is a little bit higher than it was before, and you got to take into consideration that change once again from going from the standard to the itemized to kind of really figure out the actual benefit that you're getting with regards to investment in the property and the tax benefits that you would have to it. The best way to figure that out is to actually just do projections, use software, actually do the calculations with and without the property, including the taxes and the interest versus not having the taxes and the interest. And then you also want to kind of project that out into the future as the interest portion will decline if you have a standard kind of 30-year loan. And then you could calculate that basically out into the future. So they do not include taxes charged by home renovations or for services like trash collection. As noted below, the Tax Cuts and Jobs Act, the TCJA, capped the property tax deduction along with other state and local taxes, starting with the 2018 taxes. So note, this was kind of a controversial component of the TCJA, and you can see it basically going either way going into the future. So there is kind of some uncertainty with regards to this type of tax, deducting, in essence, state taxes, state and local, on the federal side of things. And just to give you an idea of kind of why that is, why that risk is there with regards to your investment decisions, it's basically because on the federal and state side of things, you would think that they would be separate with regards to their responsibilities and the way they tax, meaning the Fed would tax whatever they're going to tax and take care of their responsibilities. The states then should tax however they want to tax to take care of their responsibilities. That means that the state could tax any way they want, meaning they could have a sales tax if they wanted to, you would think. They can have an income tax, they can have the property taxes, and so on and so forth. But when you have the deductibility of the state taxes on the federal side of things, then the Fed kind of has a little bit more influence on how the states tax, because if you deduct certain types of taxes differently, then that will influence the way the states will then tax. Also, of course, states that have higher taxes, it incentivizes states to increase their taxes, right? Because if they increase the taxes, then the state can collect the taxes and we still get the benefit on the federal side to get basically a refund. So it's kind of like subsidizing the states in that way. And therefore, there's a controversy, of course, with the high cost of living states that might have much higher taxes that are getting a much bigger benefit from, the deductibility of the state taxes. So you got this controversy. So again, with regards to investment, that means that this deduction could kind of swing either way. You could see it basically going either way as in terms of, is it going to be more beneficial or less beneficial in the future. So in any case, the law capped the deduction for state and local taxes, including property taxes, at $10,000, $5,000 if married filing separately. So you got this cap that is on there. So basically, you can't go above that in terms of the itemized deduction. And again, this is a big one, because if people started another thing that often pushes people over from the standard deduction to the itemized is if more well-off people typically end up paying more taxes. And if there's a state tax area, they have to pay state income tax, for example, it's likely that their state taxes are going to basically start to go over and above the 10,000 cap. And then that cap, again, becomes significant. Again, it becomes a lot more significant oftentimes in high cost of living areas, right? So previously, there was no limit on that deduction. So the owner of the property must pay taxes assessed annually by a state and or local government on the value of the property. So that's the way the property taxes generally work. You got the value of the property. They assess the property taxes. You have to pay the property taxes according to whatever the state and local requirements are. And then the question is that deductible? In essence, what's the tax benefit on the federal side of things generally? A property owner can claim a tax deduction on some or all of the property taxes paid if they use the property for personal use and itemized deductions on their federal tax return. So this itemized deduction, again, a key point, because if you're not taking the itemized deductions, you're not going to get a benefit from it. These two things are usually the things that push people over: the ownership of the home, then, including two things, the interest deduction and the property tax. Those are the two big ones that push people over. But again, that deductibility of those two things will not be as high as you think if basically there's a gap between the standard and itemized deduction before you go into it. So it really depends on your circumstances. Got to do projections in the tax software to really get a good idea of that. In other words, get the tax software or work with an accountant or work with software, run the numbers without having the home, without having the itemized deductions, without having the deductibility of the taxes, and then run it with, and then look at what the actual difference is in the current year, and then see if you can project that into the future. In the future, the interest on the mortgage will actually go down. You can run, best case and worst case scenarios. What would happen if they just eliminated the property tax deductibility and so on and so forth, to just do different scenarios in that format. So understanding the property tax deduction continued, the real estate taxes that can be deducted include taxes paid on closing when buying and selling a property and taxes paid to a county or town's tax assessor on the assessed value of the personal property. So you might have a situation during that point in time of closing process where the property taxes accumulate at that point in time. And the question would be the deductibility of those taxes. Personal property, according to the Internal Revenue Service, IRS, may include a taxpayer's main home, vacation home, land, or foreign property. Special consideration: taxes paid on rental or commercial property and on property not owned by the taxpayer cannot be deducted. So if it's a rental, then no. In addition, a home buyer who pays the seller's delinquent taxes from an earlier year at the time the sale was closed cannot deduct these taxes payments on their taxes. And the reason is that the delinquent taxes payment is instead treated as part of the cost of buying the home, meaning they're rolling it in because it was a prior tax prior to the purchase. They're rolling it in and considering it part of the home purchase instead of basically paying for the property taxes. So special consideration: also a property owner's tax bill includes miscellaneous items that are not allowed to be deducted for tax purposes. Some of these include payments for improvements made to local residential areas such as sidewalks, and fees for service delivery and as trash collection. To understand that portion of a tax bill qualifies for the deduction, refer to Form 1098. You can find Form 1098 on irs.gov, which is reported by the bank or lender to the IRS and sent to the property owner. So how to claim a property tax deduction. To claim a property tax deduction, the tax must apply only to the value of the personal property owned and be charged on an annual basis, irrespective of when the government collects it from you. Therefore, if the state tax was only charged at the time the property was purchased, then it does not meet the IRS definition of a deductible personal property tax. As stated earlier, property tax can only be deducted if the owner chooses to itemize deductions, and obviously you would only be itemizing, as we've discussed, if it was greater than the standard deduction. So you're looking at that difference between those deductions. These components of owning property typically being the items that push many people over from standard deduction to itemizing. To make sense for a taxpayer to itemize deductions if the sum of all their eligible itemized expenses is greater than the standard deduction allowed in a given tax year. Pros and cons of the property tax deduction. From time to time, there is talk of eliminating the property tax deduction. One of the arguments for doing so is that the deduction, along with the federal mortgage interest deduction, discriminates against renters and encourages people to take on more debt. So again, there's a lot of debate over these items as to the deductibility. The idea of basically deducting kind of personal items like the home is not something that would naturally be in like an income tax system. You would think the natural things that you would deduct for income taxes would be the things that you had to spend money on in order to generate the income, so that they're taxing you not on gross income, but on net income. And personal residences don't really fall into that category. So they're kind of a special thing. And the special thing argument usually was that we're going to allow deductibility to try to incentivize people to purchase homes and so on. That's one argument, that one debate that goes about this. The other debate that goes about this is the fact that, different states are going to benefit much differently with regards to the deductibility of state and local taxes, depending on the cost of living of the area that you're in. So that becomes a big debate as well. And also just the separation between the Fed and the state, meaning how much independence should the states have from the Fed, and how much of that independence is taken away when the Fed does things like incentivize the way the states should be able to tax and so on through having the deductibility and kind of subsidizing in some ways certain states that are doing certain things that they might like on the Fed side. In any case, proponents of retaining the property tax deduction say that it promotes home ownership. So and again, if you think about the argument between home ownership and renting, you would think that if someone is renting, they might be more likely not to be as affluent, has as much wealth, and therefore why would it be the case that you're not giving any benefit to the renter and you're giving benefits to the homeowner? So you can go back and forth on that. And then the argument against that is, well, we're trying to get people from renting to home ownership. The idea there being is that home ownership is like a goal in and of itself. To own a home is inherently better than renting or something like that. And therefore, to have the incentives for home ownership would drive people to want to own the home. From an economic standpoint, in terms of investing, these kind of laws, many economists might argue that in the long run, they're just kind of muddying up the field in terms of what people kind of know, because these laws will then be kind of baked in to the price once people understand exactly what's going on, once the information is out there. So it complicates things. But in the end, if it's a capitalistic market that's going to be fluctuating with these changes to the laws, and people are able to understand the benefits and cons of these different laws to them, then the market will take that into consideration when they start to value the property, and the prices will basically change accordingly to the benefits that the tax code is either giving or not giving to people. So really it might just be, from that standpoint, making things a bit more complex, but in the long run, the market kind of equilibrizes it out, right? Pros and cons of the property tax deduction. The Tax Cuts and Jobs Act, the TCJA, of 2017 capped the deduction for state and local taxes, including property taxes, at a total of $10,000, $5,000 if married filing separate, starting in 2018. Previously, there was no limit to the deduction. In addition, under the new law, homeowners who deduct mortgage interest were limited to the amount they pay on $750,000 worth of debt, down from $1 million. Interest on homes bought on or before December 15, 2017 is guaranteed a special exemption at the previous rate. Because the standard deduction doubled in 2018, the predictions are that fewer homeowners will itemize their deductions. So they increased the standard deduction, which again kind of lowers the benefit of these kind of itemized deductions. Thus, fewer property owners will claim the property tax deduction. The standard deduction is revised every year. For tax year 2020, the standard deduction for couples filing jointly is $24,800. The deduction for single filers $12,400. For tax year 2021, the standard deduction for couples is $25,100. The deduction for single filers is $12,550. So remember, we're referencing here Investopedia, property tax deductions by the Investopedia team. It was reviewed by Leah D. Iradu on February 28, 2021. As time passes, especially with tax law, they could change in the future. You could go back to Investopedia and see if they update things as time passes. Obviously, you will also want to be taking a look at the IRS website, the irs.gov, to continue your research.